Minutes to the Federal Reserve's meeting in March show that the staff says the effects of the banking turmoil would likely lead to a mild recession later this year. It sought a recovery from that recession in 2024 and 2025. The staff had previously seen the recession as a possible alternative to its baseline forecast. Now it seems to have elevated that to the baseline forecast.
Welcome back, you legends. The Fed just dropped the recession bomb. That's right. The Fed minutes released today revealed that the Fed expects banking crisis to cause a recession this year. This is the first time the Fed has actually admitted that their new baseline expectation is that the economy is going to enter a recession in the back half of this year. Now, what happened today? We had the inflation report drop. We had core inflation come in at 5.6%, a 0.1% increase over the previous month in line with expectations, but the headline inflation number was at 5%, a whole percentage point below last month and 0.2% below expectations. Now, we did in fact expect that this would happen. If you watched yesterday's video, congratulations. This is exactly what we expected to happen today, and that's a pop, a top, and a drop. That's exactly what happened. We had a pop in the pre-market session. The expected move was 414 to the upside, 406 to the downside. The market ended up rallying to 412, slightly overtaking these previous highs from March 31st and April 4th. However, the market failed to take out these prior highs. It confirmed a massive bearish divergence. It topped, it dropped, and that was it. I put out this note, guys, just as the market opened today. The PPO for the NASDAQ futures has already rolled over, suggesting that a top in the triple Qs can come as early as today, and we got that. Then we had the Dow Jones hit our resistance line, also will begin rolling over. We also got that today. This is our trading community where I post all of my analysis, daily live analysis, all of my trades, my trade setups, my weekly watch list and weekly expected moves, and every single chart that you see in the YouTube videos you will find in my charts. We have over 1,400 active members in the community and we are continuing to grow. So thank you so much everyone for your incredible support. This is the best way to support me if you want to support the channel. So I really appreciate it. Other ways you can support me, guys, is by slapping that like button. I do appreciate every single one of you that does that on your way, and thank you so much, guys. Now expect a lot of negativity to pour into the market, especially as the market now will very likely push to fill all of these unfilled gaps below 403 and 401. Remember that tomorrow we'll have PPI as well, so expect volatility to continue in the market. Now, why did I say that we expected inflation to do this? Well, if you haven't watched yesterday's video, please go back and watch it. We discussed this extremely rare bearish signal based on the inflation data. And let me pull this up on my chart here. Up top, guys, is headline inflation divided by core inflation. Usually, guys, in a healthy economy, headline inflation should outpace core inflation in any expansionary cycle. When the opposite happens, when core inflation begins to outpace headline inflation, you get an inversion of this ratio. You get a dip below 1. And every single time this has happened, guys, it preceded a recession, including the 2020 recession, including the 2015 to 2016 double dip recession, and the 2012 mini recession, the 2010 mini recession, and the big Cajone, the 2008 recession. Now on this chart, it doesn't look like a lot, right? These look like minor pullbacks, but they're not. These are major sell-offs. In fact, guys, if I pull up the same chart, let me just show you what happened after each one of these signals triggered. This was the last signal, guys, just before the pandemic, and the market had a 33% correction in a couple of months. In 2015, December 2014 takes us back to this point in time. The market tried to rally, it hovered, it floated for a few months, then it had a prolonged period of weakness, a double dip decline, each about 15%. Let's take a look at April 2012, and that's right here, guys. And again, we had an 11% correction. In May of 2010, that's right here, May 2010, we had a 15% correction. In October of 2008, we had the majority of the bear market declines, and the market saw, let's see, a 40% decline from October to the bottom. And so that's what the market is doing right now. It's just buying time. It's just eating time off the clock, weakening and weakening until those earnings really show significant economic weakness, and we will likely start to see that, guys, as early as this week. We have JPM and Wells Fargo reporting in a day, and we'll start to see the banking crisis have the tightening effect that all of the economists are now talking about. It's estimated, guys, that the banking crisis, the collapse of SVB, Signature, all of those banks is equivalent to the Fed raising rates by 1.5% in a single month. So that's a major shift, and that's pretty much why the Fed is now saying that it expects recession in the back half of the year. And all of that is happening as core inflation remains super sticky. It has gone up this month, and in fact, it is expected that next month both core inflation and headline inflation will go up again based on what I'm seeing in the swaps market. And if we take a look at the yield curve inversion, this is the 10-year yield divided by the 2-year yield, and as long as it's sitting below 1, it's flashing a huge red flag warning of a recession. Every single time we had a yield curve inversion, the 10 below the 2, we had a recession follow in the next 12 to 24 months. We are now in the 12th month since the yield curve has inverted, and so we are now expecting a recession imminently within the next 4 quarters, very likely coming in at the back half of the year. Now, if we focus in here, guys, and zoom in, we will notice a very clear pattern, and it's this. The majority of market declines actually come after the yield curve has inverted and after it begins to steepen again and exit inversion, right? If we take a look all the way back to the 2008 bear market, the 2008 recession, this is the yield curve right here. It exited inversion on May of 2007. The market pretty much topped a month later, then it dipped, made a second top, a double top, and the market ended up really suffering one of the worst recessions in recent history. If we take a look all the way back to the 2000 to 2003 bear market, same thing here. The market exited inversion in January of 2001. All the way here. And then again, we ended up with a major decline. The market declined by 40% after the yield curve actually exited inversion. So we all know the recession is coming. We've been hearing it all over the news for so many months. And if you relied on the yield curve inversion to actually try and sell or short the market, you will have ended up early. And that's because of the dynamic that we just discussed. And that's when the yield curve actually begins to steepen. That's when most of the selling come. Now, this entire sell-off from the highs of 2021, where the S&P topped at 480 and it bottomed at around 350 last October in 2022. This was actually just a correction. This was not a response to recession. This was just a correction in response to higher interest rates, to the Fed's interest rate hiking cycle. Now, the hiking cycle is coming to an end. The Fed will very likely hike one more time and one final time. That's going to be in May, early May, May 3rd. That's going to be the next Fed meeting, and they will very likely announce the final rate hike. And from that point on, the market will begin to trade based on economic news. Bad news will be bad news again. Good news will be good news again. Now, the Fed has been raising rates for over a year, and usually it takes about 12 to 18 months for the Fed interest rate hikes to trickle into the real world economy. So we're looking at the real effects from the Fed hiking cycle beginning to take effect now. The first of the dominoes to fall was SVB and Signature Bank. We'll begin to see a lot more dominoes fall, and we'll likely see even bigger, even larger funds, banks, you name it, financial institutions begin to suffer significantly. We'll also start to see all of those blue chip stocks like Apple, Amazon, Google, Tesla, all of those stocks begin to suffer considerably, both in their top and bottom lines. In fact, if we take a look at Apple, we have been calling for a top in Apple really for about a couple of weeks now. I've been talking a lot about this resistance line. We had a perfect rejection on April 4th. Apple ended up topping. After it topped, it also broke below this ascending channel. And every single time Apple has done this, the S&P pretty much topped and reversed, right? Every single time. If we take a look at the last time it did this, it was February the 10th, and the S&P had one final attempted rally. It completed a major divergence, then it sold off. The prior time, if we take a look at the August high, pretty much the same thing here, guys. Apple broke below its ascending channel on August the 22nd, and pretty much the S&P had already topped 5 days prior. It's been happening systematically, including the channel that Apple developed and broke back in early April of last year. Here it is, April 6th, broke below it, the channel. The S&P had already topped and began to roll over. It's pretty much the same story with Google, tagged perfect resistance, the upper edge of our ascending channel, rejected immediately the next day, and it's been selling off since. Same thing has been happening with Microsoft, topped on April 6th and has been selling down since then. AMD was the first of the dominoes to fall in the tech sector. We talked about this all the way back here on April 4th. We said that the market will now very likely top in the next 5 days. And what do you know? It ended up topping exactly 5 days later. That's kind of funny. NVIDIA, what is happening with NVIDIA? Again, major resistance. Look at this pivot zone. It's been a major support zone back in December of 2021. Then we broke through it. It became resistance once, twice, and now for the third time. Look at this perfect rejection. If we take a look at the semiconductor index, the SMH, the saying goes, where the semis go, the market and the economy follow. That's because the semiconductors sector is a hyper cyclical sector. It rallies immensely and outperforms the market in booms, and then it massively underperforms the market during busts. And if we take a look at the 2008 as well as the 2002 bear markets, you will notice that semis really suffer the greatest losses out of any index. Really, from the 2007 top all the way to the bottom, the semi index lost 65% of its value. And between the 2000 to 2003 bear market, again, semis lost 85%. So why do I bring this up? Well, because the SMH has actually been significantly underperforming the SPY, the S&P 500, for quite a while. Even though the market was actually rallying back here at the end of March, semis were actually making a lower high. In fact, let me add the S&P so you guys can see what I'm talking about. Look at this. So this is the S&P in blue and black, and it was still rallying here even though semis had already topped and made a lower high on a relative basis. And it's been continuing to sell off for a while now, and even on the daily chart we can clearly see a massive negative divergence between the high here and the prior highs back in February. So semis here again are tipping us that the economy is indeed weakening, and we're seeing money flow out of semiconductors and into defensives. And in fact, if we take a look at the weekly performance so far, guys, we had utilities, healthcare, energy, basic materials, industrials, financials lead the market. Cyclicals and tech, communication services all lagging. So we have the risk on sectors that you would like to see rally in a healthy economy, they're all selling off, and the defensive sectors that usually outperform the market during really bad times, those are now outperforming the market. And we can see the same thing, guys, on the stock market map today. We had hyper cyclicals like consumer discretionary, Tesla and Amazon, as well as semiconductors, all suffering major losses today. Now let's take a closer look at the daily chart for the S&P 500, and we've got this very clear double top formation, both major sell-offs at the 412 level. The S&P has failed now twice to clear this level. Sellers are committed at this zone very heavily so, and on the 1 hour chart we can clearly see again a massive double top formation with a huge negative divergence. Look at this massive negative divergence. And again, the market did pretty much exactly what we expected it would do. It completed this nasty bull trap that we mentioned yesterday, a pop higher, then a drop and a completion of a double top, right? So we had a pop and drop and a completion of a double top. And we are now on our way to fill all of these gaps below. If I measure the distance between the double top and the neckline, we get objective minimum target of 399. So all the way back here to fill at least two gaps, the gap at 401 and the gap at 403. We can clearly also notice a major shift today, guys. Look at this. This is the first day where we had a close below the 9-day moving average, this light blue line. It held several times, really, never closed below it since this pullback back here on March 16th. The market has held above it since then. And if we take a look at what happens usually, guys, after we break below the 9-day, we get further weakness, potential bull traps, and even more weakness. Now, on the smaller time frames, guys, I'm going to show you exactly where the objective short entry for the day was and how you could have traded this exact setup. So let's take a look. So we had a gap up, we popped, then we dropped, we had another attempted rally, we made a lower high, many rejections here. This was clearly a bearish signal, and so at this level, the objective short entry would have been at clearing, sweeping the lows here. So you would have entered a short here, and then you would have taken profit as soon as the histogram switched from red to pale pink right here, right? So this was a pretty decent move, right? A $2 move. If you're trading options, that's a lot of money. And the next objective short entry, guys, was this, when we had this triple top formation on the 5-minute chart, right? Double top, then one final attempt as the Fed minutes were released. The PPO had already crossed down. We had a significant bearish crossover. An aggressive bear would have accumulated short positions at every single top, right? And then just held. But the objective short entry was at the sweep, right? After we had swept the lows right here, you would have entered a short at 410.5, and you'd have held it towards the end of the day and potentially closed at the end of the day to take profit. I thought I'd share something different with you guys, really very small time frame analysis. I hope that it benefits you guys. And if you like this kind of very small time frame analysis, please comment below and I'll do more of it. Now let's take a look at the BPSPX. And once again, look at this beautiful negative divergence, double top on the price action and a lower high on the BPSPX. Again, this has marked prior tops in the market. And if we take a look at the triple Qs, we have the first bearish crossover on the PPO. And remember, guys, tech is what saved the market really since the March 13th bottom. Money flow out of the financials and the indices and into the NASDAQ, the big cap tech companies like Apple, Google, Microsoft, etc., all of which have already topped. And so we're getting the first bearish crossover on the NASDAQ here. And pretty much, guys, after every single one of these, the market ended up with a major correction, and the end of an uptrend. Let's take a look at the Dow Jones. Again, perfect rejection of the resistance line that I mentioned yesterday. Look at this. We opened just above it, then we dumped immediately and closed at the lows of the day. This looks very bearish, guys. All of the indices look pretty bad. But the worst so far is the NASDAQ because it's the first to produce this bearish PPO cross down. If we take a look at the risk on, risk off ratio chart, XLY consumer discretionary divided by XLP consumer staples, again, we continue to see lower highs and lower lows, guys, lower highs and lower lows. And again, this continues to suggest more weakness, especially as volume to the downside has been rising. So expect even more weakness in stocks like Amazon, Tesla, etc., and the overall market to continue to weaken and find more and more sellers. I do want to mention, guys, that tomorrow we'll have PPI before the market opens, so we could still continue to see the market continue to chop here as it finds more and more selling pressure at these levels. The NASDAQ will very likely now lead the market down. Remember, guys, we needed the NASDAQ to lead the market up. As soon as we had this bear pennant complete and break to the downside today, this is a decision made to the downside. And so rallies in the NASDAQ will now be met by continuous seller demand. Now let's jump to the smart money and dumb money indicator. This is my own indicator, guys. I call it the smart money and dumb money because the bond market tends to be much smarter than the stock market. Unfortunately, that's the truth. And what we had today was very telling, right? We had a double top with a lower high on the HYG, the high yield bonds, and an equal high on the S&P, and that's a very clear negative divergence suggesting that more weakness is coming to the S&P 500. This is pretty much the same signal that allowed us to catch this major sell-off in the S&P 500 back in November as well. Now let's jump to the VIX, guys. The VIX actually closed flat on the day, surprisingly. Even though the market had a major sell-off today, the VIX closed with an indecision doji. Now, indecision dojis, guys, or spinning tops or whatever you want to call them, these are indecision candles, and when you find them at the top of a move, usually it indicates the end of a trend and a reversal is coming. And when you find it at the bottom of a trend, usually indicates the end of a downtrend and the beginning of an uptrend. Now, a new uptrend in volatility would mean a new downtrend in the S&P 500 because as volatility rises, the S&P 500 declines. We've been clearly trading within a range, a very clearly defined range for several weeks now. And as soon as we break above this range, you'll see a lot more selling coming to the S&P 500. If we take a look at the weekly chart, it looks way more bearish, way more negative for the S&P because we have this very clear positive divergence, these higher lows on the PPO, the weekly momentum for volatility has been rising. It's been curling up, and the same thing can be said for the RSI, right? It's been curling up, and that's a very bad sign because the last time we had a volatility curl up like this was back here, guys, back in October of 2021 at the top of the NASDAQ, right? Look at this volatility beginning to curl up, a higher low on the PPO, even though we made a lower low versus the prior lows. PPO was higher. We had a bullish divergence on the PPO for the VIX, and we had a major rise in volatility, and the market top was in at that point in the NASDAQ. So this is a major red flag that yes, volatility is right around the corner, and we will likely see an explosion volatility, especially as we enter the earnings season that's going to start as early as tomorrow. If we take a look at long-term treasuries, bonds, again, we talked about this double top for several days now, and it has marked prior tops in the S&P, right? We had a double top in TLT, a higher high on the S&P, and it marked the top. We had the same thing happen again, a double top, and it marked the top on a closing basis. We haven't yet managed to close above that 411 level since really April the 3rd. So again, this indicates more weakness is coming to the S&P, at least, guys, at least to fill the gaps below. Once we do that, we will assess again whether the market will try to make another high, an equal high, or whether we make a lower high and begin a prolonged and very bad downtrend. Now, if we take a look at the 50-day breadth for the S&P 500, you will actually notice, guys, that we had a pretty bullish close for breadth today, right? We did not sweep these prior levels, while the S&P has actually had a significantly more bearish close. This means that we have to keep an open mind for more choppy trading before the market could begin a significant downtrend in earnest. So again, we will need to see these gaps get filled, and we will assess from that point on if the market continues to make an equal high or a higher high while the breadth indicator makes a lower high. That will very likely signal the end of this uptrend for the S&P 500. Now, if we take a look at the 200-day breadth for the entire stock market, not just the S&P 500, we have a very similar look, right? We have a double top here with a higher high on the daily price action and a lower high on momentum. An identical look to what we have on the S&P 500 today. If we go back, guys, to the February top, we actually had breadth tell us that the market had already topped on February the 9th when we had the first switch from green to red, the first bearish crossover on the PPO. We don't have a crossover just yet. So again, even though we're leaning bearish in the short term to fill the gaps below, the trend remains bullish until we get a bearish crossover on the PPO, which hasn't happened yet. And if we get a bearish crossover at the zero line, if the PPO continues to rise and then get a bearish crossover at the zero line, that would be extremely bearish. Failures at the zero line are very, very bearish for momentum. That will send the market significantly lower from this point on. Again, if we take a look at the summation index for the New York Stock Exchange, summation index remains positive. We did have a lower high on the McClellan oscillator, right? Even though the New York Stock Exchange made a higher high today. So that is a bearish divergence. Keep in mind, guys, that these bearish divergences can develop for a prolonged period of time before we get the final top, right? The final top. We have a local top here that will likely send us to fill the gaps below, but not yet confirmed whether this is the final top or not, right? We really cannot confirm that the top is in until the summation index crosses down. The NASDAQ summation index looks so much weaker, right? This is the summation index for the NASDAQ. This is the NASDAQ up top. This is the S&P 500 in blue and black. And down below is the NASDAQ McClellan oscillator. And again, very weak looking. Reminds me of this period of weakness back in March of last year. And if we get a bearish crossover on the McClellan summation index for the NASDAQ, we will likely see the S&P follow, the New York Stock Exchange follow, and we will likely see significant lower lows from here. And the gold standard, the money time machine put to call ratio hasn't yet completed a cross below our 0.8 level, but we're getting very close, guys. We're getting very close. The last time we had a close at that level, look at this. The market topped exactly. So we might be looking at something similar to this, guys, a deep pullback, a continuation of the rally, and then a final top. We don't know yet, but this is a tradable top that we can trade to the downside. Now let's take a look at the fear and greed index. We got a reading of 62. Look at this. Greed is still high despite the sell-off today. So again, guys, the market tends to top around the 75 reading. Not there yet. So just proceed with caution. This is a tradable top, a local top, not yet confirmed as a final top, but we can trade this top to the low side, to the downside, to fill the gaps below. And if we start to see some bullish signals emerge again, we can trade the market back to the upside and short it again when it makes sense. And that's what we do as traders, guys. We just follow the signals, and right now the signals are bearish for the short term, bullish for the medium term, and extremely bearish for the long term. I hope that makes sense, guys. I'm really trying to give you the most granular analysis that I could possibly give you with the information that we have, with the data that we have. And it's telling us, again, short term bearish, fill the gaps below, and we'll see what happens from that point on. If we see the 20-day moving average, this dark red line hold, we will likely see again another push higher, and we can trade that move to the upside. We do not have a bias as traders, guys. We can trade the market to the downside, to the upside. It doesn't matter. We make money either way. And guys, just in March, in this choppy period of trading, we made a 90% profit. So it doesn't really matter. We can trade the market in any condition as long as we follow our rules and we remain disciplined in our entries and exits. And again, if that's what you're looking for as a trader, please consider joining our trading community. It is bar none the best trading community on the planet. And we have so many incredibly talented traders that I continue to learn from. And as a community, we continue to learn from each other. So market momentum has now stalled at the 412 level, rejected twice. We will likely see this point allow us to fill the gaps below before we see another rally, a counter trend rally, a new high. We don't know yet, but likely now a gap fill below before we move higher. Stock price strength, it is now slowing below the zero line. Stock price breadth, it will now likely begin to slow as the market begins its stopping process, right? Put to call ratio, we need to see this dip below 80 to really begin those prolonged, very severe sell-offs, very severe downtrends. Market volatility is curling up, and that's a major worry now for the bulls. Safe haven demand, bonds are now beginning to outperform stocks again, and we're seeing junk bonds being dumped. So to summarize, guys, today we did have a pop and drop, exactly what we talked about in the last video. Please check that last video if you haven't seen it yet. A lot of valuable information there. We had a pop and drop and we completed a double top. This changes the trend in the short term to be objectively bearish. Again, potentially allowing us to fill the gaps below before we see the market move higher. Again, if we hold at this 20-day moving average, that would be bullish if the bulls manage to hold at the 20-day moving average and at the 50-day moving average, and we begin to see a continuation of the rally. That will be bullish for the bulls, and we will trade that to the upside yet again until we find another top and we short it, and so on and so forth. Thank you so much, guys, for watching till the end. I really appreciate folks that watch to the end. I really love you guys. If you like the video, please don't forget to slap the thumbs up button on your way out. It helps this channel a lot. Thank you so much, guys, and I'll catch you in the next one. Bye-bye.
Oh, wow.